Welcome to the Family Office Sherpa podcast. I'm your host, Shaun Parkin, founder and managing director of Whole Road Investments. The aim of this podcast is to provide practical and implementable advice for those looking to build, manage, or service a family office. This is not, however, investment advice, so please check the disclaimer in the show notes. And for anyone interested in the Whole Road platform and what it looks like, including service fees and engagement types, please reach out to Shaun, S-H-A-U-N, at wholeroad.com.au or ping me on LinkedIn. In this episode, I'm going to go through the 5 ways I see families create a resilient investment office.
This is the Family Office Sherpa.
So, what brought this on? I guess there's been a couple of reports, and there's a recent one from UBS, which I thought was pretty interesting, and I'll include that in the show notes. And I read through the whole report, and I think the biggest thing or the notable thematic wasn't around optimizing the portfolio for returns and things like that. You kind of got from the survey results that people are looking not to hunker down or to, go into their shell or whatever, but potentially having a look at how resilient their investment office is. The instinct when markets get uncertain or rocky is to do something big, sell the thing that is down, pile into something that's holding up. The families who come through it best, I find, are the ones that tend to do almost the opposite. They create small, deliberate moves off a structure honestly that they've already built, right? That resilient structure. And I talk about scaffolding a lot here. That's exactly what I'm talking about. It's built to last, right? So this isn't an episode about some strategic asset allocation or tactic, some asset mix or trade or whatever. I'll leave that to others. What it's about is the whole investment office, how it's set up, and when that shock hits, because let's face it, a shock always hits at some point. You're adjusting from a position of calm rather than reactive. Or reaction to a position of fear a lot of the time, right? So I'm going to go through 5 things I keep seeing in families that, in my opinion, have built this resilient structure. So, number 1, they treat asset allocation as a living thing, not a document. It's really interesting to watch. So one of the things that I do in investment committees is I often bring a cliff note if that's part of the process, right? And when I say that, it's like, what's our strategic asset allocation? What is it currently? What's our current weights? These sorts of things just keep people reminded around sort of what we're trying to do here. The officers that are, like I said, have built this resilient process is that they've got a cadence for reviewing the investment policy or reviewing their asset allocation. Not just a once a year tidy up. I mean, SAA is a long term, but, often requires a yearly review. But they have a habit of revisiting the assumptions behind the allocation. You find that they're just naturally curious a lot of the time, or the investment people are curious people. This is not tactical or dynamic asset allocation. What we're looking for here is, do our assumptions hold up? When the world changes, and I'm starting to hear things like post-consensus world, when they're looking at their portfolio, they're not tearing up their strategic asset allocation. What they're doing is you often find that they'll revisit assumptions. Are these assumptions correct? They might a few degrees of adjustment of a position that they already understand it, but they look to make sure that it still holds, that the thesis still holds. The families that panic, in my experience, are nearly always the ones that have set the allocation years ago, probably when they did their first investment policy, maybe 5 years ago or whatever that ended up looking like, and then they've never looked at it again, and then a crisis hits, and this is potentially the first time they've thought about it properly, and this is the worst time to do it, right? This is something that should be done calmly, diligently, all that sort of stuff. And when it's all hitting the fan, it's very hard to do that. So the point here is not to make, to make more trades. They really just know their portfolio. They know it well enough that you don't have to make big decisions under pressure, right? That's what I see. Number 2, they chase real diversification and not just the appearance of it. there is a strong tendency to believe the name on the tin for people in this space. And it makes sense. If it says this on the tin, you're thinking, oh, they have gone through all the requirements of compliance and all that sort of stuff. But if a fund says diversified or all weather or global or alternative, don't just say, oh, well, that's in there. Let's tick the box and we're good. Resilient officers are those officers that have built good structure, are those that look under the hood. You got to look through to what we actually own. And this is really, I find this in private markets in particular, because there's not a lot of transactions in the, say, like venture or private equity or something like that. If they're raising an on-call, capital call structure, it just sort of, and getting an understanding of what that capital call is for is sometimes the trigger. So we get a capital call. It's for this particular investment. Oh, okay. Well, let's look at that. Does it hold up with the thematic that they talked about? Is it in the space that they talked about? All these sorts of, is it diversified away from others? Are they actually doing what they said they would do? The other version I've seen of this sort of, lack of diversification is when people collect counterparties, more managers, more banks, more products, and assuming that, spread equals safety. But 5 managers all holding the same handful of stocks or handful of positions isn't 5 different bets. It's one bet dressed up 5 ways. Over diversification, redundancy, whatever you want to call it. It's that kind of thing that when people go, oh no, I'm very well diversified. I've got this manager, this manager, this manager. It's like, hang on, they all look very similar. Why do we have them? That's just because one says, I don't know, this factor, and this one says this factor, or this one says all weather, or, it doesn't necessarily mean that they are truly different. Real diversification is about what the underlying exposures do, not how many labels sit on the page, right? So this is why I do love a portfolio review. I do love that cadence with it. And that's why I love investment committees, because investment committees are, that's a big function, not to determine investments and things like that. It's more pre and post investments. Like, is it doing what it said it would do? And the resilient officer looks through those labels, because 2 things that move together in a crisis aren't diversifying, no matter what they tell you. And this is the bit that bites a lot of people. They feel diversified right up until everything they've thought was going to run differently ends up moving in the same direction. And we've seen that multiple times, and I've seen that multiple times through my career, which is, we thought we were diversified. Hang on, why is everything moving in the same direction? So that's, just being really diligent about the underlyings is really, and look, to be honest, I'm a naturally curious person. I enjoy doing that anyway. Number 3, they build the governance so they can act calmly under pressure. Investment committee, investment policy statement, the investment reporting, all of it's in place, all of it's working before we actually need it. I think, we had the Family Office Scaffolding Forum recently and have done 2 this year. And a big part of that is what's that investment reporting piece, either from your counterparties or internally. Getting it right when everything is kind of benign or kind of relaxed or chill, rather than, okay, we've got to seek this data. What do you mean we don't have this data? How is this not happening? Is this accurate? I don't know. Our counterparty hasn't delivered this. Why not? All these sorts of questions that, there's, to a certain degree, you could put some stress tests through this and say, what happens if this goes to this? Do we know where the data is? Are we comfortable with it? Is our counterparty going to be able to provide for us? All these sorts of different things, right? And is the investment committee, do they know what we should do during these cycles? Does the investment policy govern it? What some people always ask me, what's the veto within your office or the offices you work with? The veto is the investment policy. Investment policy dictates what can and can't in the portfolio. So, the trap a lot of the time is treating governance like paperwork, as I've mentioned. In investment policy, we wrote once and never look at it's decoration. It's just bits of paper. The resilient version is the one that actually shapes what you do when it's tempting to go off script, as I've said. Like, what's the criteria? Why do we have this in the portfolio? It's really, really important. Good governance, unfortunately, sometimes, for some, and I've had this conversation, feels kind of bureaucratic. It's like, oh, Shaun, it's not the language that we like, governance and structure and policies. And I'm like, yeah, but it sounds like that until you need it. And it saves you from decisions that you potentially regret. That's what good governance should be. And that's my job a lot of the time. Anyway. Number 4, they keep conviction in long-term themes, but stay selective. We're not talking about abandoning good long-term themes just because it's a noisy week. I mean, it's always noisy these days. I mean, I remember I worked in finance. I started in 2000, and the internet was starting to really become a big part of stockbroking, right? Which is around information and things like that. You just sort of found that it became noisy. And can you imagine 26 years later how noisy it is now? And I think part of my job and part of the job of the advisors and the internal staff is to make sure that, we what's signal, what's noise. That's what we're looking for here. The difference between believing in something and betting the house on it, right? You can hold conviction, but you can still be disciplined, right? So that's what we talk about when we talk about conviction. But don't abandon long-term thesis just because something from the cheap seats or someone from the cheap seats is starting to make more noise, right? Number 5, they make the office itself survivable. This is a harder one, right? So all the portfolio resilience in the world means nothing if the office itself can't keep running through change in leadership, change in key people, and it happens all the time. So resilience of the investment office a lot of the time is dictated by some version of what does succession look like, right? Continuity of people and decisions. And again, I go back to the governance structure, which creates continuity. It creates this idea that, and the way that I sort of frame it a lot of the time is, if someone came from outside this office and said, what does this investment office do? How is it governed? What's the investment committee? All these sorts of things. We should be able to really clearly, quickly say, this is how it is, right? If you can't, then it won't survive some of these changes. So the version I see the most often, an office that depends on, or quietly, or not so quietly, depends on one person knowing where everything is and how everything works. That's not resilience. That's what you'd probably call a single point of failure, right? And so that's what we sort of talk about. The good ones have redundancy. They have an ability for this to keep going no matter what. And I think that's a really, really important piece. So anyway, that's the 5. So in closing, you pull it all together across all the 5. It really is just the same idea, which is build the structure before the stress. Build the structure before the stress. So when you do make moves, or the market make moves, or whatever during these stressful periods, the moves you make are probably very small, right? None of this is dramatic. It's just a series of unglamorous decisions made ahead of time. And honestly, that's why it works. So hopefully that was helpful. If you're enjoying the podcast, please ding the little alert bell. That's super helpful. You get the notification, the next one's published. Please visit the Sherpa website, which is at www.thefamilyofthesherpa.com, where you can see the podcast, newsletter, guides, and videos. Till next time, thanks for listening.